Hi, Matt McAleer, Director of Equity Strategies at Cumberland Advisors, May 20th, just after the close. I'm with Shaun Burgess. You know Shaun, Portfolio Manager on our Muni desk. We're going to talk about equities and lead that into a discussion on fixed income and what Shaun is seeing. So this week, we're getting there now. All year, drip, drip, drip. I hate drippy markets. Real pressure down this week. That starts to identify opportunities. So I know when the markets are running, everybody looks for opportunities and ignores risk. And when markets are getting hit, everybody's concerned about risk and they ignore opportunities. So I have a buy list together. As a matter of fact, in our tactical account today, Tactical Trend, Shaun, we bought some pharmaceuticals. Farm ran solid earlier this year, pulled back about 10, 11, 12% off its highs. We bought just a starter position with using the Van Eck Pharmaceuticals ETF. So we bought into that nastiness around 130, quarter to 2. So that takes our cash down to 25, 26%, still plenty of cash left there. U.S. Core will be looking for some names next week. U.S. ETF, same way. And why? We're down 20 here in the S&P, give or take. More importantly, after 25 or 30 years in this business, you have a stable of indicators. Some of them are analysts that I've worked with for years. Some of them are clients.
Yeah, we talked about that today.
That I've had some for years. And you get used to them indicating to you that they've gotten too negative, which will create opportunity on the positive side. Because you hear what I like to discuss, Shaun, on our morning calls is what can go right, what can go wrong in any position, in any market. Right now it feels like the markets on the equity side and the fixed income side are focused on what can go wrong. Let's click off a couple of things that might go right. You saw Walmart, Costco, retail get hammered this week. They had bought too much inventory because of the supply chain issues. With too much supply, that may start to dampen some of the inflation we're talking about. Fed is a big axe here in the markets. If 3 months down the road, 6 months down the road, the markets have taken care of some of that inflation, and the Fed doesn't have to be as aggressive. So that's something we think about. We're keeping our eye on interest rates, and we'll jump over to Shaun. Nice to see the 10-year trading in a range. Let's call it 280 to 310, right, Shaun?
Yep, found nice stability in that area.
If rates can find a range, other asset classes can get priced, right? Equities are trying to price in a heck of a lot right now. War in Ukraine, interest rates, oil, which is still a headache, at $1.12 a barrel for West Texas. That's a primary concern of mine. I think rates will take care of themselves. So we're going to be opportunistic. When we get this kind of negativity, we start looking at what sectors are holding up best and showing a little change in momentum. Right now, it's drugs, transports to some extent, and believe it or not, because everyone hates growth, semiconductors. Really trading well relatively. Let's shoot to bonds. Tell us about Treasuries this week.
It was really a tale of two markets. Treasuries lower in yields. You pointed out stability. Very important to see the market reach some degree of stability, because then that gives investors confidence to put money to work and know they're not just going to see a price that's lower the next day or the day after that. And that's really what you want to see. We saw that a little bit in the 10-year, saw that a little bit in the 30-year. We had the 30-year come back below 3% off of some fears about recession, stagflation, driving that kind of flight to quality.
Even fear in the equity market buying treasuries, right?
Yeah, it's going to drive that. So you really saw treasuries move lower in yield. Munis still looking for that base, still looking to bottom out. So that's where we think you see a tremendous amount of opportunity. You know, we talk about it every week, that tax-free municipal bond at 4, 4.25, 4.5. Tremendous buy in our opinion. And you know what? We're putting money to work, looking to go out and buy those yields with the expectation that, as treasuries get pushed lower in yield, there's some reversion to the mean, and munis end up benefiting from that as yields come down. So
yeah, great info. We talk about, and you've heard me say this on the video before, as a trader or an investor, don't get too down or hard on yourself. Nobody trades any market perfectly. Just be flexible and understand that if you're buying a bond, buying a nice AA credit muni at 410 and rates still go a little higher, sure, you're going to take a little crimp on price there, but we're talking about a 410. Yep. We're talking about a 410 yield. That's a 6+ taxable equivalent.
Yeah, average it up. I mean, even if you give up a little bit, that kind of structure tends to be a little bit more defensive than when yields are at 2%.
Right.
And when you're banking 4% tax-free, as you said, we know top marginal tax rates aren't going anywhere. Whether they'll be higher in the future, we don't know that either, but we know at a 4% tax-free rate, tremendous buy versus a treasury at 3%.
Good, good. Don't get too high, don't get too low. Look for opportunity while respecting risk. Don't forget to like, comment, and subscribe. Have a great weekend. We'll see you next week.